All right, now that our cattle on feed report for September is out of the way, kind of wanted to go over a little bit of a scenario for you, just kind of showing you how I would handle my hedges. And we're just going to use April. April cattle now is coming online. Uh, we I break these down into 3 months increments, starting 6 months out. The reason I do that is because that's approximately how long it takes to feed out a backgrounded 800-pound animal. So I'll go 6 months out. I'll break them into 3 months increments. So what I do is I come up with a 10-year average, and the time frame October through December in April cattle gives us a 10-year average high of 123 and a low of 121. That is a really tight range. And then I will use a factor. This and these are based off of fundamentals, based off of our cattle on feed report, and factor that into those averages, and I come up with 117 about to 115 and a half. Again, pretty narrow range this far out. So I'll put them into my, that's the price barometer. I put those into my percent to hedge scale, and it spits out what level of hedge I should be based off of fundamentals and prices. The problem is going this far out, it's telling me to be 100% hedged at 117. Well, April cattle already 117. So what I do is I have an error, and I generally, as far out, 6 months out, I'll put a 2 or 3% error in there. Gives you a little bit larger range. And now with a 2% error, I'm at 117 and 50% hedged. When I'm looking at the January, the 3 months prior to the contract expiration, I generally do not use an error. Also, with April cattle, you want to look at what just does the future seasonal look like, and you could tell just from the price barometer what it'll do. 10-year average for April cattle between October, November, December is 123. January, February, March is almost $10 higher. So we already know that April cattle tends to rally in the first part of the year versus the end of the previous year. We can also back that up with a chart view. This is April 21 cattle. We typically bottom out in early September and then go higher. So am I going to want to, just on this seasonal factor, am I going to want to do a lot of hedging, knowing that futures tends to go up and price barometer looks like it could go up? Probably not. Not unless I'm really happy with whatever current price the futures are giving me. So when I want to feed cattle, and I'm putting together a hedge plan. The first thing I got to know is what my break even is. And this chart here is just a general break even based off of the CME feeder steer index, which closed Friday at $1.42, giving us a break even of $1.18.9, just say 119. And that is if I buy an 800-pound animal and my cost of gain is 85 cents a pound. Now, if I was doing it myself, if I was feeding them out to 1,300, 1,400 pounds, I generally considered I could do it for 75 cents a head or pound gain, and that drops my break even lower. So this is just a general reference for now. Let's just plug in 85 cents like I'm going to throw them at a commercial feedlot. And it's not always going to be 85 cents. I've had a buck 10, which was awful, down to 70, which is way better. But let's just use a buck 85 and use a buck 19. Now, if I were to buy these 800-pound animals and my break even is a buck 19, and I looked at futures and I said, oh man, April cattle is a buck 17. I can't even hedge that. But the cattle industry, for lack of a better term or whatever, is based off a lot of hope or luck. I don't know. But I'm a firm believer that you can use the data from your seasonals and increase your luck significantly. And so I would be I would be willing to take the risk in buying those cattle for a buck 42, even though my break even is a buck 19. I can't hedge that. I would take that risk. Why would I take this risk? Is the first thing I look at is my cash. So here's a look at a 5-year seasonal cash versus what we are doing currently. 5-year seasonal tends to bottom in early October and then increase. Well, there's a low of 108 and let's just say increase to 119. That in itself is a $10 gain, a $10 or actually 10-cent per pound gain. 10 cents on a 1,350-pound animal is 135 bucks an animal. So just that alone is going to tell me that I have a better chance of breaking out even or making money just based off the fact that our cash is going to go up. I look at is my basis. And like the cash, it tends to bottom out in early October. 5-year seasonal says a negative 11 cents basis, and we peak before about April at 6. That is telling me we have a 17-cent swing in just basis. So what is 17 cents on a 1,350-pound animal is $230 of equity gain if I were to buy calves right now and sell them in April. So my chances of making money buying calves right now and marketing them for April, even though right now I can't hedge them at a gain, is pretty decent. I would go ahead and make that call, especially if they were my own calves. I would buy calves and feed them out for April. So, what point do I hedge these cattle, or what do I do? What's my hedge plan? Well, we know basis is a strengthening condition, cash is up. So, if I was happy with the futures or the price the futures gave me to hedge, my cash up scenario says to bull spread, which means if I'm going to throw a hedge on, it's going to be in those back months because they are not going to increase as fast as the front months in a cash up situation. So I get a bigger bang for my hedge buck in those back months. Strengthening basis tells me to long cash, and I'm going to be because I have a bunch of hooves in the feedlot. And if I have to short futures or if I am happy with whatever price it gives me, I'm going to be short futures, long cash, short futures. All in all, though, in a strengthening basis, cash up scenario, I want to have no position. again, this is just based off of whatever scenario the producer has, or if he needs to hedge, whatever. They're not all situations are alike. And it's telling me, the objective is telling me not to be in the way of the cash uptrend. And if my profit objective is met, use options and decrease my percent of hedge with a bottoming cow. So in this scenario, if I want to protect that uptrend, buy some cheap puts, buy put spreads, something like that, um, to protect that uptrend. Otherwise, in April cattle, if I'm feeding, and I'm buying them calves right now in April cattle, I'm going to currently have no position. And if I am in the hedging game, I have cattle in the feedlot, they're going to go in approximately April, and I want to use the April board. My barometer is telling me that it would be better to hedge between January, February, March than October, November, December, and then use your percent to hedge scale to determine how aggressive you should be hedged based off the fundamentals. So let's just say futures gives me a 122 mark sometime between now and the end of March. I'm going to want to be in that 86% hedge range. If I was using the cow, let's say the cow tops me out at 122, I'm going to look at my hedge percent to hedge scale and know that I need to be about 80%, 86% hedged at 122. So that's kind of how I would play it. This is just me and kind of what I've developed over the years. Most of this was just in my head, and now I'm throwing it on paper and I'm tweaking it a little bit, because once I get my brain on paper, I look at stuff and I think, what? So this is good, and I think this is a really good, nothing is black and white, and this is as good of a hedge plan as I've seen, or any. And it requires a lot of discipline to look at your cash and your basis and your cow, and do accordingly, and do not pay attention to what the percentages on the cattle on feed. Do not look at commentators, what they think. This is cut and dry as it'll get. So anyway, if you have any questions, comments, let me know. And eat some more steak. Talk to you later.